Today we're talking about one of my favorite topics, and that's credit myths. And it's my favorite topic because there's so much misinformation that it's really important to get this information out to the consumer because it can really disadvantage you. If you're adhering to or you believe some of these myths, you can really put yourself at a disadvantage when you're applying for a loan or you're trying to do anything that requires a credit report. And believe it or not, this can be anything from getting a car loan to a mortgage to even your job. A lot of times there's credit information used in your background check for a job. So you really want to make sure that your credit file, your credit report, is an accurate reflection of your use and management of credit. And that's really what it is. The bottom line of a credit report and score is your credit report is literally a transcript of how you use and manage credit. This can be credit cards, this can be how you pay your mortgage, how you pay your auto loans. So let me go through real quickly the top 10 myths that you should stop believing in so that you can protect your credit report and your score. So number one, checking your credit report hurts your score. Okay, so this is probably the biggest misnomer out there and can be your biggest disadvantage. You can check your credit report over and over and over again. In fact, the government has said it's your right. You should be provided by these credit bureaus at least once a year a copy of your report because it's that important. So checking your credit report, a personal check of your credit report, and even your scores will never hurt your credit report. It's what they call a soft inquiry, and so it's no reflection, it won't adjust. Even if you're going for a loan, anybody that's going to give you a loan, whether you're talking mortgage or auto or a credit card, they're always going to pull your credit report. So even though incrementally there may be a slight adjustment to your score because it indicates that you're going after more credit, so depending on what else is on your credit report, there may be a tiny little incremental change in that report, but it's not significant, it's not material. You should be very comfortable for a lender or yourself to check your credit report because it's a fundamental requirement of one, keeping your credit report accurate in your case, and for a lender to actually lend you the money, they're going to have to do that. So get over this misnomer that somehow using your credit report or getting your credit checked is going to hurt you. It's not material in any case. Number two, credit reports and scores are the same thing. They're not. Let me try to make it easy to understand. Your credit report is literally a transcript of how you are using and managing your credit. So if you have a credit report or a credit card, every single month that credit card company or the lender is going to report how you paid your bill. Did you pay on time? Did you pay the full amount? Are you a good or have you potentially missed or delayed in your payments? And that goes for mortgages, it goes for auto loans. So the credit report is literally a transcript historically of how you use and manage credit. This score, of which there are many, so anywhere that you pull your score, there's probably going to be a slight variation. Any lender that pulls it could pull one of a myriad of different types of scores that they use in their particular lending. So there's going to be some variation in score. So a score is literally an algorithm or a computer program they run across your report and determine based on a series of factors, of complex factors. And these scores are all sort of, or the algorithms are all sort of secret, but they'll come up with a score. And the score is literally just to make it easy for lenders to sort of determine as a summary how you're doing. And then usually, especially for more complex credits like mortgages, they'll look through the incremental credit report as well. So a score is just kind of a summarization. Again, there's a lot of different kinds of scores, a lot of different kind of algorithms. So a report and a score are literally two different things, often used together, but they are two different things. Myth number three, no credit cards or credit equals good credit score. This is a real big misunderstanding as well, and a lot of people are doing things like Dave Ramsey, which is great to pay down all your debt and get rid of all your credit cards and that kind of stuff. But remember what I said, a credit report is a transcript of how you use credit. So if you've gotten rid of all your credit, then you don't have any debt. Not that that's a bad thing, but it will be impossible to get a credit score because there's nothing to observe there. So you have to be careful about that. So there's definitely a balance, especially if you want to go after a mortgage. A mortgage you probably can't pay for in cash, or even an auto loan you probably can't pay for at one time in cash. So it's probably important for you to maintain some level of credit usage so that there's something on the report to be evaluated. So don't get rid of all those credit cards, and we'll talk about that one again here in a second. Myth number 4, unpaid bills only unpaid bills show up on the credit report. So again, that credit report shows a whole bunch of different things. It will show, and hopefully it will show, a lot of paid on time bills. So it's not just the bad stuff that shows up, it's the good stuff as well, and it all works together. And again, you can think of it like a transcript. Every time you use credit, or every time you pay your bill, or every time you don't pay your bill, or every time you're slow paying your bill, it's going to record that as a series of sort of transcript transactions. So myth number 5, paying off debt cleans up your credit report automatically. So just paying off a debt, whether it's a good debt or a bad debt, doesn't necessarily move the score. Again, the score's an algorithm, there's different types of weighting. So just because you have a bad debt, maybe you missed a payment, that blemish is going to stay on your credit report over time. And as you continue to use credit and you show that you use credit for the most part in a good way, and maybe there's a couple little blemishes, that becomes less and less significant as time goes by. But again, those things don't just because you pay a bad debt or you catch up on a bill that you were late on, doesn't necessarily remove that. So you really kind of need to overcome it with more good than bad. Number 6, debt is debt. A lot of times people think that all the debts on your credit report are weighted equally. And again, this depends on a large part on the credit score algorithm. But generally there are some debts that are looked upon favorably by these algorithms and some debt that's looked upon less favorably. So for instance, just as kind of a top line, having a mortgage is not necessarily a bad thing. Most people have mortgages, and so generally those are looked on favorably. Car loans, certain types of credit cards, generally unsecured credit cards, are looked on as okay revolving debt. However, some things like retail credit cards, which generally are very high interest rate, or payday loans and things like that, which have, again, very high interest rates, are generally only for people that are high credit risk. There's a tendency for the algorithms to sort of score that in a more negative light. So all debt, there is something to be said for having the right kind of debt. So things like mortgages, things like car loans, unsecured credit cards, and those sorts of things are generally considered good debt. You still have to watch how you use them, of course. Myth number 7, closing a credit card will help your score. Actually, it will probably most likely hurt your score. So again, there's a couple of different things that are at work here in the algorithm, but as it pertains to closing a credit trade line, so that could be a credit card in particular, or generally these, you want to show a long period of history of using credit in a good way. So having a credit card that you've had for 10 years and then you've paid on time all the time each month is a really good thing. If you were to close that credit card down, you just by virtue of that would shorten your credit history because it wouldn't see that past stuff. So you generally want to leave good credit lines open. If you have too much credit, or you just can't handle it, or you're not good at managing credit, there may be some other reasons to close down a credit card so you won't use it and you can just sort of discipline yourself. But in general, it's best to leave your creded lines, like credit cards, open and available. It'll also help your utilization. If you have a credit card that has $20,000 worth of credit on it and you don't use but a little bit of it every month, you'll have a very low utilization rate. So 70, 80, 90% of that credit card is available and unused, which again is a positive sign in most scores. Myth number 8, credit bureaus give out good and bad credit scores. Good and bad credit scores are entirely dependent on the lender that's looking at the credit score. So generally there's kind of rules of thumb that 720 and above is better, and as you get down to 680, 620 and those sorts of things, starts to be sort of worse. But it's literally dependent on the lender on what a good score and a bad score is. And generally all they do is adjust the interest rate that they charge you. So higher interest rates for the lower end of the credit spectrum. But there's no per se good and bad credit score. It's all in kind of, as they say, the eye of the beholder. Myth number 9, a better job or higher income will improve your credit score. This is another really common myth. So just because you have a lot of money doesn't necessarily mean that you're going to have a great credit score. In fact, a lot of people with a lot of money don't have a lot of credit, and maybe they have no credit score, or they have a lower credit score because they've had a few lates and they just don't use credit. So having a lot of money doesn't necessarily indicate a good credit score, nor does not having a lot of money. So you may not have a lot of income, or you may not have the best of jobs, but you're really good about paying those bills on time, and you have a few credit lines that you've had for a long period of time. There's a good chance you're going to have a really high credit score, even though you may not have the best job, or you may not have the most income. And last, myth number 10, paying debts will automatically erase them. So if you have a bad debt in there, or a charge off, and there's all kinds of sort of approaches to this, I'm not going to advise you on how to do this, but it is important to know that just because you pay a debt off doesn't necessarily all of a sudden jump your credit score, doesn't automatically get rid of that blemish on your credit report. So do those things in a kind of a logical progression. So it's good to pay off your debt and those sorts of things. But if you've had something that's been charged off, or is already in collections and those sorts of things, you're probably going to get need to get some additional advice, or do some additional research to see incrementally how to deal with that blemish. So bottom line, as we talk about all these things, it's important to know credit reports are a transcription of your use and management of credit. It is your right to keep tabs on that and to make sure it's accurate. And make sure it's a true reflection of how you manage the credit report. So you should be getting a copy of your credit report on a regular basis. And you should be comfortable having lenders, if you're looking to get a loan, having lenders pull your credit so that they can take a look at what your credit is in order to help you maybe improve your credit, but also give you the loan and the funds that you're looking for, let's say for a mortgage or an auto loan or a new credit card. So feel comfortable with that. The credit score, it's important to remember there are a whole bunch of different credit scores. Whether a credit score is good or bad is really in the eyes of the beholder or the lender. And really all that is an algorithm that runs across that credit report and gives sort of a summarization of what your credit history has been, usually for the purpose of helping a lender provide you credit. So those are the top 10 myths. Down below there'll be a link that'll have an article so you can kind of read through those, or you can go through a checklist. But hopefully we've cleared up a whole bunch of myths that will make you a better handler and maintainer of your credit report and score, because it is your right, and you should make sure that it's accurate in all cases, because believing any of these myths here can really set you up for a bad experience when you're trying to actually go and get a loan or a mortgage or an auto loan or a credit card. So hopefully that helped you clear up a whole bunch of myths about credit. Take care of that credit report, pull it if you haven't looked at it in a long time, and take a look at what's on there and make sure it's accurate. Have a great day.